It may happen the day after you put all that money into the 401k, and maybe the markets crash that same day, and maybe you lose all that money. What's up guys, thanks so much for joining me for another video. My name is Adam Nelson and all my videos are about money. So last week I made a video about 401ks, and specifically I spoke about the difference between a traditional 401k and a Roth 401k. And a lot of people know the difference between those two already, but if you don't, go check out that other video. And I think a lot fewer people know the difference between a Roth 401k and an after-tax 401k. In fact, I think a lot of people think that they're actually the same thing, when they're not at all. And actually, I was just rolling over my 401k from my previous employer over into my current 401k, and when I had to call my previous 401k administrator, they told me that a Roth and an after-tax 401k was exactly the same thing. They didn't know the difference themselves, which is crazy. They work with 401ks all the time. That's their job. Shouldn't they really know the difference between the three types? Anyway, I just barely learned myself what the difference was, and so in this video, I'm gonna be sharing that with you. Before we get into things very much though, please consider liking this video if you learn anything new, and consider going and checking out my other videos. Also, if you want to learn more about 401ks and money in general, then consider subscribing as well. Okay, let's get into things. So like I mentioned, I just barely learned what the difference was between a Roth 401k and an after-tax 401k. And the way I did that was, well, basically I was doing research into what a mega backdoor Roth contribution is. And it involves an after-tax 401k. I'm not going to be talking a ton about mega backdoor Roth contributions, but I will mention it later on in this video if you're curious about it. Okay, so first let's talk about what the two types of 401ks have in common, both the Roth and the after-tax 401k. And again, I'm ignoring the traditional 401k in this video. Both Roth and the after-tax 401k mean that you contribute your money after you've paid tax on that money. And the other thing that a Roth and an after-tax 401k have in common is that all the contributions that you make to either one, when you go and withdraw them when you're in retirement, you can do that without paying any additional taxes on those amounts. Now note, I said contributions that you made, not the actual earnings, because that's where it gets different. So with the Roth 401k, obviously you've paid taxes on the money that you contribute, and then all of the earnings that you make in your Roth 401k over time until you retire and withdraw that money, all of that grows completely tax-free, which means you take it out and the government has already taxed you on the initial contribution. All the gains are all yours. But where an after-tax 401k is different is that on your earnings, when you pull that money out, and you may be able to do that before you hit 59 and a half years old, correct me if I'm wrong, I'm still learning about this stuff, but when you withdraw your earnings, the government also taxes that money at that time, and so it kind of counts as income for that year. So say I pull out $20,000 in earnings in my after-tax 401k, to the government's eyes, it looks like I made $20,000 extra that year, and they're gonna tax me for that. And that may bump me into a new tax bracket depending on where I am already. So that's something that you need to consider with an after-tax 401k. And the other thing that's unique about a Roth 401k compared to an after-tax 401k is that it's subject to the same contribution limit as a traditional 401k, meaning you can only put $19,500 into a Roth 401k unless you're 50 or older and you have some catch-up funds that you'd like to contribute as well. And I think that limit is around $6,500 or $7,000 in 2021. And the thing you need to keep in mind for a Roth 401k contribution is that any amount that your employer also matches and contributes to a Roth 401k as well does not count towards that $19,500 limit. And so this means if your employer contributes, let's say $5,000 and you max out your $19,500, then in total you could have contributed a total of $24,500 to your Roth 401k. Now where an after-tax 401k differs is that it has a higher contribution limit than your Roth or traditional 401ks. I believe in 2021 that amount is around $58,000 total can be contributed to 401ks. So for your after-tax 401k, if you wanted to contribute to it, then you would subtract probably the $19,500 you've already contributed to the traditional or Roth or a combination of the two 401ks. You would also subtract the amount that the employers contributed to your traditional and Roth 401ks. So you take $58,000 and say you've contributed your $19,500 to a Roth 401k, and let's say that your company matched $5,500. So in total, you have $25,000 contributed to your Roth 401k, and you still want to contribute more to your after-tax 401k. What you do is $58,000 minus the $25,000 already put into your Roth 401k, and that leaves you $33,000 that you can still contribute to your after-tax 401k. And just for completeness, I also want to mention that there is also a catch-up amount for your after-tax 401k that you can contribute if you're 50 or older. And I believe in 2021 that amount is $64,500 instead of the $58,000 that most of us are subject to. I'll also mention that it may depend on your employer, but I think most employers don't actually match when you contribute to your after-tax 401k. This means if you have the choice between contributing to a traditional, a Roth, or an after-tax 401k, typically you want to first contribute to either a traditional or Roth 401k so that you get that company match, because that's essentially just free money that you would be passing up otherwise. So the other thing that's different about an after-tax 401k is the liquidity. And this means that basically you can withdraw, depending on your plan, the amount that you contribute to your after-tax 401k pretty much at any time. You're not subject to the same rules that you are with a Roth or traditional 401k, where you have to withdraw that money after you reach 59.5 years old, or retirement age. And this can be really useful for a number of different applications, potentially. And just to reemphasize this really depends on the plan, so you should probably reach out to either your HR representative or maybe your 401k plan administrator to find out what your specifics are. And so if you do want to withdraw that money that you've contributed anytime before you're 59.5 years old, and no, I said contributed, not earned, then generally you can do that tax-free. However, if you're pulling out some of the earnings that you've made in an after-tax Roth 401k contribution, then that money's going to be taxed for that year. And so that goes back to the example where I was saying if you withdraw $20,000 of earnings from an after-tax Roth 401k, then to the government it's going to look like you've made an extra $20,000 that year. And you need to be aware of potentially bumping yourself into a new tax bracket. And so yeah, when you pull out your contributions from an after-tax 401k, generally speaking, it's not going to be taxed. But when you pull out the earnings from your after-tax 401k, that will generally be taxed. Now you may also be wondering who can actually contribute to an after-tax 401k. Maybe you've never heard about it, or maybe you don't know if it's on your plan. So I don't know either. It actually does depend on the plan that you're on, and so you'll probably have to also reach out to your HR department or your plan administrator to figure out whether you can contribute to an after-tax 401k as well. And one other thing that I want to call out, because it applies to me personally, is that highly compensated employees probably can't contribute very much, if anything at all, to an after-tax Roth 401k plan, even if it is supported by your plan administrator. Now, without going into too much detail about what a highly compensated employee is, this is basically because other employees at the same company aren't contributing a bunch of money to their 401ks, and so the government decides to limit how much highly compensated employees can contribute to theirs. That way they don't have an unfair advantage. At least that's what the government says. I don't really totally agree with that reasoning or rationale, but I digress. Let's move on. And I'll actually make another video probably about what a highly compensated employee is and what some of those ramifications really are when it comes to contributing to either a traditional Roth or after-tax 401k. Okay, so now that you know the core differences between a Roth and an after-tax 401k, you may be asking yourself, why would anybody choose to actually contribute to an after-tax 401k? Especially when all of the earnings are taxed when you withdraw that money, whereas with a Roth 401k, they're not. And that's a really good point. And I would say that probably most people don't contribute to an after-tax 401k until they've already maxed out their Roth 401k or traditional 401k. And it's for exactly that reason. Either with a traditional 401k where you get the deferred tax benefit, or with a Roth 401k when you have no taxes due on any of your earnings, that's typically better than contributing to an after-tax 401k first. However, let's imagine you have a lot of extra money and you've already maxed out your traditional or Roth 401ks, and you have this other money that you want to save somehow and you want to invest. If you wanted to, you could put potentially quite a bit of money in your after-tax 401k, and it could potentially be a really good investment. Basically, the benefit is that after you pay your taxes on your initial contributions, the money that's inside and earning and growing more and more is all tax deferred, meaning that it'll grow and grow and grow without paying taxes on it until you withdraw it. And so another way you can kind of think about this is that the government is giving you a bunch of little tiny loans, and they're saying, okay, we won't take our taxes out of this money yet, we'll let it stay in your hands and it can grow faster. When I was doing some research about after-tax 401ks online, I also read that some people were suggesting that you store maybe an emergency savings in your after-tax 401k. But personally, I would never actually do that, because if I want an emergency savings, I want it in an account that's extremely liquid, basically that I can access anytime, and I want it in an account that I know is not going to depreciate in value, which can happen if you're investing in the market. And 401k investments are still investments in the market. And so if there's a bad year or something, maybe you don't have all the emergency funds that you thought you did. Now, I may just be paranoid a little bit, but when there's an emergency, you don't know when that's gonna happen. It may happen the day after you put all that money into the 401k, and maybe the markets crash that same day, and maybe you lose all that money. And so for me, it doesn't seem like a very safe vehicle to hold all of my emergency savings. And so the other reason you might consider contributing to an after-tax 401k plan is if you're interested in what's called a mega backdoor Roth contribution. Just really high level here, the basic idea is that any money that you contribute to your after-tax 401k can, in theory, be converted to a Roth account. This depends on your specific plan as well, so you need to talk to your HR or the 401k administrator about this too. And you need to ask them if they support something that's called an in-plan conversion. If your company's plan doesn't support a Roth 401k, you probably can't convert that after-tax 401k contribution to a Roth 401k immediately. Even if your company doesn't support in-plan conversions to a Roth 401k or a Roth IRA, whenever you leave your employer, if and when you ever do, you can still convert that money into a Roth IRA at that time. One technical detail to note here is that if you contributed to after-tax many years ago and then you leave your current employer, if you convert all of that to a Roth IRA, then you're gonna owe taxes on the earnings that you've made in the after-tax contributions. So the amount that you've actually contributed to the after-tax 401k, all of that you can roll over to Roth IRA when you leave your employer tax-free. That's already been taxed. However, it's all of the earnings that would be taxed if you roll that into a Roth IRA at that time. However, you can also get around this potentially by converting the earnings into a traditional IRA and converting your original contributions to an after-tax 401k into the Roth IRA. And then you wouldn't owe any taxes immediately. Eventually you will whenever you withdraw that money, of course. Or you can get really fancy and you can convert the traditional IRA into a Roth IRA over time. And that way, potentially, you prevent yourself from bumping yourself into a higher tax bracket any single year. Now, this all gets pretty tricky, and I'm not a financial advisor, so go talk to one if you are considering doing this. And also, if you're interested more in what a mega backdoor Roth contribution is, just let me know in the comments and I'll make another video about that as well. Anyway, I really hope that this video was helpful. I hope that you learned something, and if you did, please like the video, please subscribe, and check out some of my other videos as well. I hope you have a great day, and until next time. Basically, you have a larger lump sum of money that you can... No, it's not. That's not true because it's Roth. You pay the tax on it first. Oh, yes it is. Employers won't match that money, and I think I've already said this, so I'm not going to include it. Sometimes I forget what I say already. So, okay, let's move on, okay? That's a wrap.